At what point is the Fed going to look at each other and say, you know what, we've whipped inflation here. Let's just start cutting rates. They're not, I don't see that happening.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Welcome, everybody, to this week's Interactive Brokers podcast. I'm Andrew Wilkinson, Director of Trading Education. I'm joined by my colleague, Steve Sosnick, who's our Chief Strategist, and Senior Economist, Jose Torres. Welcome, gentlemen.
Hello, Andrew. Hello, Jose.
Hi, Andrew. Hi, Steve. Great to be here again.
It's great to have you back. We've got a lot to talk about. Let's get straight into it. Jose, last week we had the March employment data, somewhat of a softening. The private ADP reading showed a decline in employment from 261,000 to 145, and then the official government reading from the BLS showed a softening from 326,000 to 236,000. We've still got an unemployment rate very near the historic lows of 3.5%. We've also got this week consumer price report due midweek. Inflation looks like it's heading from 6% down to 5%. How critical is that in the context of what the Fed's job ahead is?
Great question. Let me start off with jobs. So the discrepancy is a lot narrower when you take out government employment from the BLS, which was a big boost for March employment. Private sector employment slowed significantly. When you look at some of the cyclical areas like manufacturing, construction, and retail, those all lost jobs in March. When we look at the ADP report, without the contribution from small and mid-sized firms, we actually would have lost jobs because large companies trimmed a lot of labor in March. As far as the unemployment rate, we're starting to see folks come back into the labor force. We're seeing the labor force participation increase. Historically speaking, the unemployment rate tends to be very low immediately prior to recession. And I think that's where we're going, consistent with the 2023 economic outlook that we released in late December. As far as consumer prices, the report this week will show some relief in the overall categories, particularly because oil prices softened in March. However, the services category is still extremely problematic. In fact, when we look at the jobs report, the leisure and hospitality was the big gainer in both the ADP and BLS jobs reports. Folks, while they're not spending on big ticket items, durable goods like furniture, refrigerators, stuff like that, or vehicles, they are spending on experiences. A lot of that is due to the pent-up demand from COVID. And that area, leisure and hospitality, continues to have big labor shortages. It tends to be lower paid. Folks aren't as ecstatic to go into work in that sector. And that's driving a lot of the services inflation. I think that this CPI report will be cheered by the market, but I think that the one we receive next month, due to oil prices, we have our in-house models here showing that the April inflation report, which comes out in May, is going to be particularly hot. As far as the Fed, we've seen a monetary policy juxtaposition in March where they've essentially put out the fire in the banking sector by raising their balance sheet and providing liquidity, but at the same time still providing guidance that they're going to be increasing rates, right? So that's looser on one side, tighter on the other. I am of the bias that they're going to go higher for longer.
Very good. So, Steve, last time we sat down a month ago, there was a banking crisis going on.
Okay, there still is.
What banking crisis? It doesn't feel like there's one right now.
It's always difficult to say. Nobody rings a bell and says the crisis is over. You don't get that. The first banks that went down were what I would consider the weakest sisters. You can point to something with each of them. Signature Bank was crypto related. It's pretty clear what's happened to crypto. I'm sorry, Silvergate was the first. I misspoke. Silvergate was crypto. SBNY's Signature was also crypto, and they had a penchant for being involved in sort of all the weirdest corners of New York area finance, taxi medallions, lending to real estate companies that were otherwise shunned, that sort of thing. SVB was a very unique situation, and Credit Suisse has been problematic for years, certainly since the Archegos debacle. And so, this is what you get when you have interest rates rising. It's a bit of a culling of the herd. And, SVB pointed out the classic duration mismatch, which is, banks have always tended to borrow short and lend long. They did it in extremis on both sides, and it handcuffed them to a point where they couldn't recover. I think right now you're seeing a lot of machinations among various banks and among various depositors trying to reassess things. And as you get those kind of readjustments throughout a large segment of the banking system, it's too early to say you won't see something else, but I cannot tell you what it will be, and I certainly hope there won't be.
And we have financials kicking off earnings season this week. I think what you're saying is it's too early to tell, but will we learn anything from that?
I think so, and I hope so. It's funny because I'm on record various times saying I hate the fact that banks lead off earnings season. They're typically a terrible harbinger for what's to come because their business is so unique, and really the only thing they tell you about earnings season in a normal year is what their customers are saying or what their CEOs tell you their customers are saying to their bankers. This year is quite the opposite because I think so many eyes are focused on the banks. I think what you get first are the big tier, the money center banks as they were. They're getting lots of inflows of very, very cheap money. They pay almost nothing on their deposits. But, that's sort of the flight to safety, so to speak. And I think it'll be interesting to see how there's this sort of the sequencing between the money center banks, the JP Morgans, the Citis that tend to go first, and then the following few days into the next week of the mid-tier banks and where their money is going and what they're telling us. I have a feeling the latter part will be a little more interesting because, quite frankly, the money center banks have a nice business if they want to. They can pay you a basis point on your deposits and then go out and lend it to the Fed for 480 or so. So that kind of works for them.
Jose, are we more or less likely to land in recession as a result of the banking crisis? What's your opinion?
More likely. Recent data show that lending is down significantly on a percent change basis. It's down lower than during the Great Financial Crisis. Deposit outflows are also down significantly to levels that we haven't seen in decades. Taken together, like Steve said, that leads to the cost of funds for regional banks to increase as they try to perhaps drive more deposit inflows, while at the same time, because lending is falling, they don't have the same yield opportunities, right? So that essentially leads to earnings being subdued, the banking sector rather, continuing to be in consolidation, a lot of mergers, a lot of acquisitions, more failures this year. In terms of recession, this is occurring at the same time that consumers are becoming exhausted. Prices are still rising. They are rising at a slower pace, but they are still rising at a time when employment opportunities are starting to soften significantly. Like we said earlier, I'll also add the job openings have been coming down pretty quickly. Initial unemployment claims have been rising pretty quickly, not at an alarming level yet, but again, it's a delta kind of analysis there that's worrisome. And I think overall, the credit crunch and the consumer slowing down at the same time leads us to recession in the second half.
And Steve, what's the bond market telling you now?
The bond market is telling us that they fear recession. It's very clear. I think the real question becomes for equity investors and as well bond investors is what's the pace of Fed tightening and the pace of inflation fight. I'm imagining myself at, let's say, maybe not even the May Fed meeting, but the June meeting, or even the subsequent ones to that. At what point is the Fed going to look at each other and say, you know what, we've whipped inflation here. Let's just start cutting rates. They're not. I don't see that happening. They're stable prices and full employment. It's clear from the last employment report that maybe things are not as robust as they were, but they're still pretty full. So we have an unemployment rate of 3.5%. Are they going to just start cutting the rates because we go to 3.8, because we go to 4.0? You can argue full employment, and just give me a yes or no, Jose, because we're running low on time. Full employment is probably somewhere closer to typically somewhere in the 4.5% range, no?
Correct, yes.
And so I think it's barring some sort of accident or some sort of catastrophic recession, I think the bond market is way ahead of the Fed, certainly ahead of the Fed rhetoric, but I think ahead of the Fed logic. And that, to me, is the real economic question that we're going to be wrestling with for the weeks and months going forward.
Steve Zuznick, Jose Torres, thank you very much indeed for joining me today. And don't forget, folks, please visit IBKRcampus.com for all your financial news, commentary, and learning needs. And look out for more additional audio commentaries at IBKRpodcasts.com.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at IBKRpodcasts.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education material, such as webinars at IBKRwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.